Hello everyone, welcome to another Guns and Money Markets video, the second video in this new content series. Didn't want to wait this long. It's been about a month since I put out the last one, I think January 27th. But in any event, things have been a little crazy and I've been working on another project that is almost done and that will free up a lot of my time. So glad to get in front of you guys. The first video is just kind of an introduction to the Wall Street Bets crowd and what I took away from that unfolding with the GameStop equity, with a lot of the other YOLO equities out there that got put in that gamma squeeze. I thought that was an important kind of event as just to gauge the temperature of where we are in this country. So I'm maybe pulling a lot of threads outside of markets with that story. So I wanted to focus on what I think are some of the most important macro charts out in the world today, especially if you're in the US like I am here in Ohio. So without further ado, we're going to get straight into this macro update for February. So let's take a quick look. What do we have here? We've got nominal rates. These are Treasury rates. Blue is the 30-year, red is the 10-year, 5-year is green. So why do I show these are nominal rates over the last cycle. Why do I show this? Why do I have a picture of the head of the European Central Bank, Christine Lagarde, on the background of this deck? So one of the things that we have been told to expect at almost every turn in the market or every turn in the economy is, oh, don't worry, central bankers have your back. They are going to do some more QE, some more quantitative easing. They're going to buy some more bonds. They're going to tinker with interest rates. They're going to pull them lower. They're going to, do some stimulative things to the economy. And at every opportunity they've had to say this, they've also said higher rates, inflation, growth is right around the corner. This is the last bit of QE we needed to do. The last, drop in rates. We're definitely on our way to an inflationary breakout, which in a debt-based money system, you want a little bit of inflation. That typically means growth for a while. So I show this to show you that what we've actually seen, despite what central bankers and policymakers and various talking heads have been calling for well over a decade, is disinflation. Rates going lower. Even if some of you will recall, when we began the liftoff, the policy normalization process in 2017, I think it was 2017 through most of 2018, we were raising Fed funds. There were no more large-scale asset purchases, at least here in the U.S. We were taking rates up, and we got to all of about 3%, a little over 3% in the 30-year, just over 3% in the 10-year. I mean, rates got to 3%, and then we had the big sell-off in equities in December of 2018 that definitely caught Jay Powell off guard. He had to do the infamous reversal, not lifting off or going back down to zero. And then obviously March of last year saw nominal rates go to the zero bound again. And we're living right now through a reflation trade. You are seeing rates back up. So bonds are selling off. Their rates are going higher. Treasury bonds, that is. The rates are going higher. And the idea, again, is because we're going to come out of this pandemic-induced exogenous external shock to demand and to the normal functioning of things. We're going to come out of this with our hair on fire. It's going to be an inflationary boom. The economy is going to be roaring. We're going to have monetary support. We're going to have fiscal support. All of the sexiest things that you need to really get the buy-in from economic actors to start taking policymakers at their word. Now, the big debate right now in the macro space and in financial markets in general is, well, are we going to get inflation or are we going to get deflation? We're going to analyze that a little bit more. But one of the things kind of pointing to deflation is this chart. And these are real rates. So this is just the 10 and 30-year Treasury, 10 in blue, 30 in red, less their respective interest rate expectations over the time period, or that tenor. So 10-year yields minus 10-year inflation expectations. What we have are negative rates. We've got negative real rates in the United States. And this against federal reserves, the reserve balance available to banks to lend against. So we've seen reserves, or a way of thinking about this is the collateral needed for banks to create new money in the system to fund growth. They've been going up from a balance of basically zero or less than zero to 3.2 trillion. We have ample reserves in the banking system. Jay Powell, Janet Yellen, Ben Bernanke, we can't understand why we can't generate inflation. We've got so many reserves. And the reason is and why deflationists, or the folks that have been betting on lower rates this entire cycle, why they've been right is because the mechanism that is supposed to transmit those freshly printed reserves, or the freed up balance sheet from the central bank buying treasuries, is supposed to free up the space for the banking system to go lend. But there's a big but there. If you're a bank and you don't see good credits out there, if you don't see good economic opportunities or good risk reward situations, scenarios, you might not lend. You might do something entirely different, like turn your balance sheet into somewhat of a financial engineering project just to find a way to make money in this new monetary world that has existed since 2008. The old way of finding and exploiting balance sheet space within the banking system, really around the planet, but centered here in the US, the old way is gone. And we've been using reserves and QE and Operation Twist and playing with interest rates all across the money market space. Central bankers have been doing this for 10 years, trying to get growth, and they're just not getting it. So, to this point, deflationists have been right. Now, here is a chart that I built after reading a book written by Luke Gromen. And the book was titled The Mr. X Interviews. And he keeps we don't know who Mr. X is. He keeps the identity of this gentleman under wraps that he had several interviews with. And this gentleman really kind of, I think, helped Luke plug in some of the holes to his thesis, or helped him develop a thesis that basically the United States is probably way closer to a fiscal crisis or a balance of payment crisis than most people on Wall Street or just in society and policy circles in general are respecting. And I built this chart after reading this book just to try to get a sense for what he was talking about. So what this is, it goes back to 1965 all the way up to, looks like, the first quarter of 2020. And the blue line represents federal tax receipts, current. And they have grown. They have definitely gone up over the last almost 80 years, almost 60 years. So I'm not complaining about their growth, but they've topped out. Here in 2015, we have topped out on tax receipts at about $2 trillion annually. And this is interesting because, people would argue, well, the economy's grown quite substantially since 2015. And I would say, okay, fair point. But how good has that growth been? How quality has that growth been? If that growth was distributed across the economy, across, income quartiles or percentiles, fine. I think you would see tax receipts go up. I think you would see more federal government tax receipts if the economy really was booming, as has been the story for such a long time. What else is on this chart? The green line represents total debt, total public debt as a percentage of GDP here on the right axis. It's at about 130%. And then the red line shows current expenditures, current federal government expenditures. Going in to 2020, these expenditures were blowing out, pushing up to $7 trillion. I don't have the data offhand for what our current federal expenditures are for 2020 at year end. But what I can tell you is that this is trending the wrong way. This red line, current expenditures, are going to continue to explode. It might take some time. There's rumors that Biden's $1.9 trillion stimulus package has not a single Republican vote attached to it. I don't think that's quite going to bear out to be the reality, but what it does tell me is maybe there's not as much support on the Republican side of the aisle for this stimulus bill. In any event, it doesn't matter. eventually there's going to be enough of there's going to be enough houses on fire in the real economy, enough screaming from the real public that politicians are only going to really have one option, and that's to open up the fiscal treasure, or the treasure, the public treasure. This at a time when we are not growing tax receipts is very troubling, because if you'll remember from my first series of videos about the Great Reset and why it might be needed, when I talked about the need to print money, foreign purchasers of treasuries, the big ones like China and Russia and others, they have not been adding to their treasury portfolios on net for some time. So when we don't have the tax receipts to cover, when we don't have the foreign interest to purchase treasuries on net, that puts the impetus on funding those treasuries on the U.S., on the Fed. And I don't know that the law is currently set up for this to happen directly, but basically it's going to happen. It can happen indirectly through just more QE, more large-scale asset purchases, where the primary dealers buy the bonds or the treasuries at auctions, and then the Fed just comes and buys them from the dealers. So it's not one way or the other. The Fed is the buyer of last resort for all of the U.S. government's treasury paper, and we will have to start printing the interest expense, is the big concern here. So going back to kind of Stephanie Kelton, modern monetary theory, and the idea that, well, it doesn't matter, you can't go bankrupt in your own currency. The problem is you can totally extinguish and exhaust all of the faith in holding that currency, and you can cause a crisis, a currency crisis. So just the fiscal situation looks awful, and we are just getting started, in my view, on really printing money over the next decade. I mean, it's just going to be jaw-dropping. Here is a chart of the trade-weighted dollar. Again, over this whole cycle, we have been told to expect inflation as soon as QE started in 2009, 2010, as soon as the Fed started buying toxic assets. You had the Peter Schiffs of the world and a lot of the gold bugs, which I'm gold bug-ish, but I'm not always pounding the table expecting inflation, tomorrow. These guys said, they're buying bonds, they're monetizing the debt, this is inflationary. And yet the dollar on a trade-weighted basis is in a positive trend this entire cycle. So QE has not been inflationary. And again, it's for the same reason. The Fed doesn't create money. The Fed creates a form of money that's only good for banks. And even then, the only way that money transmits to the real economy, to you and I, to the actual economic actors in this country, is through loans. And as I've been writing in my monthly newsletter, you've seen credit growth be pretty stagnant. So we've had a higher dollar this whole time, not inflationary. Going across the pond, just to, I guess, build a bigger picture that this is not just a US-based phenomenon. These are some numbers out of Euro. We've got the blue line as their discount rate. Kind of think of that as Fed funds, a short-term money rate. This is the 10-year bond rate for the Euro area. So I don't know if this is some kind of a blended average of all their 10-year rates, but just, again, gives you a sense. Rates lower this whole time. Oh, light green line here. This is debt to GDP, which blew out after the crisis in 2009 from about 60% for the Euro area, pushing up over 90%. So you've seen we're adding debt, at least in the banking system, but we are not getting inflation via higher rates. And just, again, more evidence of this. This is the consumer price index month over month rate of change for the Euro area, and the US CPI over the cycle looks the same way. So this has been the zeitgeist that, or the reality that we've been living in from an economic and macro perspective. What is happening now is it looks like things are starting to shift, again, by the fact that the East is not financing U.S. deficits at the same rate they were, and whether or not there's enough balance sheet within the banking system in the United States to finance deficits for much longer, which puts it on the Fed, which is debt monetization. I guess what I'm trying to say is how do things change from this clearly long-term deflationary cycle that we've been in to an inflationary one, which you're seeing in headlines with the backup in rates. You're seeing that all over financial press. And today, Jay Powell was sat for a hearing in front of Congress, and a lot of the congressional folks there were asking questions about, inflation. Aren't you worried about inflation or collapsing the dollar? And it's a real concern. It is a concern that I have is a currency crisis, or especially over the next 10 years. Timing and how we get there is still going to be very impactful, especially if we get some pretty big deflationary shocks. So, why do I pick on Europe? I'm not really picking on them. I just wanted to show you that this is not just US based. This is a problem in the West. And also I wanted to highlight some differences that makes me think that Europe might actually be in a little bit more of a precarious position than the US, but that depends on politics. Part of that is the sovereignty in the European Union is a little bit different than I think ideas of sovereignty here in the United States. There's a lot more, I think, natural inclination towards collectivism, or there has been, especially since they set up the EU. I mean, they do have, a monetary union and to some degree an attempt at a policy union, although Brexit in 2016, that's almost 5 years now, shows you that even the story among Europeans is living in some kind of an awesome, EU, some kind of awesome union with this collectivism, and they're all in this together and they're all going to make it work, is maybe not shaking out as well as folks had hoped in Brussels. The other reason I highlight Europe is I want it to be really well understood that this cycle is a 10-year historical record of ubiquitous central bank failure. Every time they told us to expect an inflationary outcome or here it is, here comes the deluge of growth, we never got it, especially with liftoff, with balance sheet normalization and policy normalization that was highly touted in 2017 and 2018, and also on the back of the Tax Cut and Jobs Act. We were going to be off the races, and we did get a pickup in growth. I'm not saying it was all doom and gloom, but it just was never as big as what was billed. So the inflate or deflate debate taking place in macro, as I mentioned, the deflationists have been right. Globalization has helped as China's economy and other economies in Asia have opened up where they have lower labor costs. Companies in the West have figured out that they can offshore their manufacturing and production to those countries. Don't even have to raise prices. In fact, prices can even fall, and they make more money. Their margins explode because they're saving on their biggest input cost, which is labor, almost across the board. And the key to the thesis that has been correct, the deflationary thesis, has been the banking system. Reserves are not money, and printing reserves is not the same thing as printing money. It's not Weimar Germany. It's not the 20s. It's not quite Banana Republic City yet. They could still be right periodically. I still see what I am waiting for is a policy shift and a psychology shift. So I do think we could have deflationary periods or moments, but we understand how to fix that, at least in terms of common knowledge. You throw everything at it. You pull a Mario Draghi and you say whatever it takes. And I don't think we've quite had a whatever it takes moment here in the United States like they had in Europe in 2013. And I actually think the crisis that made its way to Europe at the close of the aughts was in a lot of ways deeper and more damaging to the European economy than it was here in the US. But ultimately, the reason why I'm putting this video in front of you is I don't think a deflationary endgame is what is the existential risk that you've got to be thinking about when it comes to long-term investing and capital allocation and how you make decisions with business and just risking your resources and your time and your efforts out there to maybe engage in something that's not going to produce a return for you. So you're starting to see consumer psychology changing. not necessarily, you're seeing it in a deflationary way with the savings rate going way up. And we will definitely need to see the savings rate come down to break that trend. 2020 is going to have a longer impact on the consumer psyche here in the U.S. than I think a lot of folks on the sell side on the street are pricing in, especially the economist types. Not everyone, but the general consensus I think is a little bit over out in front of its skis a little bit. You're also seeing a change of psychology in the cryptocurrency space. Now, part of this could be euphoric mania, but also I think people, yes, want to get rich on this new asset that can go up 10x in a matter of months. That I understand. We've seen some crazy return profiles on some of these currencies, but the innovation and in the decentralized finance movement, the DeFi movement, what their folks are building stuff. It's digital, but these are cool tools. Blockchain is potentially a game changer. It could change a lot of the ways we do things and a lot of the ways we interact with companies and with the state in general. And another reason why I think that we've got to worry about the inflationary tail risk or the right tail risk ultimately as the existential risk, because policymakers are just going to throw everything at any kind of deflationary impulse. They're going to break. It's one of those, the beatings will continue until morale improves. So we could get a deflationary shock in this country that does bring about negative rates. And as much as it just totally rubs me the wrong way, I mean, I can't describe to you how much it makes me sick to even consider this, but policymakers could really, really punish folks by just taking deposit rates deeply negative, force people to go out and either spend or invest in something. Even if it's just to keep up this ruse of malinvestment and to keep asset prices as inflated as possible. I mean, that's ultimately what this is about. If we get a deflationary endgame, all of these people pictured, all the politicians that you're familiar with now, these guys are gone. They're going to go away, or at the very least, a lot of the populist ones, I think, go away because a lot of the wealth will get destroyed. But deflationary events are kind of good because while they do destroy the excess, they don't destroy the underlying system or the underlying social contract. Inflationary events, on the other hand, do. So, monetary policy is not working. I think, the charts I showed you at the beginning of this, how we've had nothing but kind of persistent deflationary forces at work at the macro level. Central bankers aren't dumb. I mean, they can pull up the Fed charts as well, right? So they know this, and you're starting to see the messaging just of all pretense to prudence is just being dropped in policy circles. Jay Powell will always defer, well, that's a fiscal thing, that's a Senate thing, when he's pressed, but in his prepared remarks, he will also always, we need to unite monetary and fiscal policy. So, he's saying, well, I'm not the guy to ask the questions to, but Congress needs to kick it in gear. I mean, you're seeing the messaging really start to build. So, how do we avoid kind of blowing up in this? We've got to stop taking our real cues from the central bankers and the policymakers. I guess Janet Yellen is no longer a central banker, but as head of the Treasury, that makes her a very influential actor in the global money space and in the political space, and really in the direction of what kind of pressure there might be on Congress to start writing some big checks. This current reflation trade off of the November vaccine announcements has been much bigger than I anticipated. And I actually think there's a little bit more room for this thing to run. Something called base effects. We're going into really easy comparable numbers for CPI, economic growth, basically across the board in the first half of 2021, because we are lapping last year's god awful numbers. So you are going to see just hair on fire positivity because of base effects in the first half of this year. But once that happens, and once we see how much pent-up demand there was if things are open here in the United States come springtime, when people are really ready to get out and have a drink and have a meal and see their friends and family, how much V is there on that second leg up? I'm kind of fading consensus. I don't think there will be as much, but we will see. But long term, we all have kind of learned how to handle deflation. You just don't buy or you just don't sell in the middle of the panic, right? What is everyone who has ever had a financial advisor here? It's about, it's more about just managing behavior and managing panic. And that is true in a deflationary cycle where policymakers are remaining committed to keeping asset prices inflated. But what happens if they lose control of that relationship? What happens if they lose control over, the Pavlovian response that asset managers and everyone on the street and ultimately consumers and business leaders making decisions, what happens when they lose that expectation, transmission mechanism? So I really think that the risk that people are talking about now, but it'll get lost the next time we have a deflationary shock, is we've got to be thinking about what Congress is going to do to the dollar, and also what China might be doing to try to circumvent or at least create competition with other reserve currencies or another reserve framework. So the other bad outcome we've got to talk about here is absolutely inflation over the long term, especially if you're younger. If you're retiring now, congratulations. I think you did a pretty good job. Maybe have a bigger cash position than you'd feel comfortable with. But, if you've had assets this whole time and you're retired, take a lap. You did it. But some things I really like. This is an ETF, DBB. This is the PowerShares base metals ETF. And you're seeing what looks to me a sneaky little breakout of a very long-term disinflationary channel. I'm not saying this is the ripper. We're going straight and up and to the right from here, but this is a big move, and especially if you see some building on this strength and continued strength. I think commodities still have. I think commodities really are going to be the secular place to be in over the next cycle. Here's the same story with crude. Again, long-term disinflationary trend after the highs and the peak oil scare going into 2008, starting to pretend like it wants to test that upper boundary. Again, long-term, 10-year trade channel it's kind of been in. If it breaks through that, you could see a lot of the folks that were kind of maintaining that level as a place of resistance disappear from the market and kind of capitulate. That could take crude to 100. And it goes, Brent's the same way. I think Brent's trading at about $3.50 above crude, above West Texas Intermediate right now. So commodities seem to be telling the story. They seem to be sniffing out this. It's early, but they seem to be sniffing out the idea that we could be heading into an inflationary environment that a lot of folks are not prepared for. So I realize now I've got this meme up here. You're not going to be able to see the bottom text because of where I put my camera. So what it says is things are now in motion that cannot be undone. And it's a very famous line from the Lord of the Rings book. And I think book, I don't know, I haven't read them all. And definitely the movies, but this was a meme a friend shared in our Discord group chat talking about doing 4 Jameson shots in a row, and your girlfriend's like, please don't embarrass me tonight. And your retort is, look, things are now in motion that cannot be undone. And I think we are nearing that trigger point with central bankers and politicians. We're getting there much faster. The rate of change is picking up much faster than I think people are prepared for, because there's this general idea that vaccines are going to be rolled out. We're going to get 100% uptake. The COVID's going to go away, and just pent-up demand out the wazoo. Plus, now we've got the tailwind in Congress. I just don't think that's the case. And I think that there is a non-trivial chance that this next cycle could see the end of the U.S. dollar-centric system, which, we're pushing 80 years since Bretton Woods. And 80 years is about the range of global reserve currency status is 70 to 100 years. So maybe it lasts another 20. Who knows? But even if it does, I still think we're going to get some inflation. But ultimately, let's keep in mind here, all is not lost, because we can decide to stop listening and trusting in technocrats and in people that, if they're not outright liars, they do just prove to be wrong a lot of the time. And eventually, if, I've been wrong before, I'm not saying you can never be wrong, but you either start getting it right, or people are going to stop listening to you. And I think, that's the takeaway here. We need to take responsibility. I think if you start diversifying into real assets, into productive assets, and this could mean private business investment. That's actually something that I think there's a lot of potential growth in entrepreneurial endeavors that will come out of some disruption, maybe at the macro level. I'm already seeing, we're starting a homestead. We're seeing small scale farming start to explode. And I don't know what else is going on out there, but I do see young people going out to take a little bit of risk. And maybe if we get, the federal monkeys off our back, we'll open that up. But ultimately, the portfolios that have been built on this 60-40 idea that have worked great for 40 years. We've seen lower interest rates and higher equities on net for 40 years. Talk about the perfect portfolio. Owning bonds is kind of like owning a little bit of a put that pays you to own it, or at least it was until interest rates were nailed to the floor. So 60-40 has been great. It's not going to continue to be great. It isn't. We need to start thinking about the 40 component, I think, a little bit differently. Or if we don't rethink the 40 component, we need to add another component to our allocations here, just to make things, not to make you rich, but just to make sure you can live to fight another day, and just to make sure that you don't blow up your precious savings and investments, and what you're putting away for your future retirement or endeavors, whatever they may be. So I do think this is an actionable and applicable takeaway for even those of us with not a lot of money in the market, but you do have some. You've got 401ks, you've got your taxable accounts, things you've rolled over from other other employers previously when you've left. So there are some really critical things to start thinking about, and they are unfolding now. And I hope that you got some value out of this. I will be back here shortly with another market update video. We'll keep it macro. I'll share I'll share another suite of ideas about some things that I like, maybe a little bit more near term. And then I'll also have another guns and money proper, kind of more political overall picture episode coming out this weekend. So thanks for your time. Thanks for stopping by. To the new subscribers of the channel, thank you. Welcome to the show. Share it, like it, do all that great stuff. We appreciate it. If you haven't subscribed yet, go ahead and click that button. Like the video. That helps us get onto all the crazy algorithms, so we can get traction and get some people finding our show here. So thanks again. Be well, and we'll see you guys soon.